Hello everyone. I hope you guys are doing okay. Welcome back to another video lectures. And I hope you guys did well on exam number 3. You know, so now after we finish with exam number 3, we will entering the last phase of our course, right? And we will prepare for the last exam, exam number 4, which will be the final, right? So exam number 4, I believe it is scheduled to take place on May 13th, I think. So, um, so after exam number 3, we have like 2 weeks until the exam, until the final, right? So, and technically we have 3 chapters left. We have chapter 12, chapter 13, and chapter 15, right? But since we are running out of time and we only have 2 weeks until the next exam, so I'm thinking of only covering chapter 12 and chapter 13, and if I have some time, I'll try to sneak in some of chapter 15 material in there, but if not, then we're gonna stick with chapter 13, chapter 12 and chapter 13, and exam number 4 is gonna be focusing on these 2 chapters. All right, so what else? Yeah, so I hope these 2 chapters. I hope the exam number 4 is gonna be a little bit easier for you guys because there's less material to cover, and I hope that will help you have some more time to go over some to study for other classes, right? So yeah, even though it is it's called final, right, but it's not a comprehensive final, except for some of you. Um, but for most of you, the exam number 4 is going to cover only chapter 12 and chapter 13, right? So only 2 chapters. All right. So let's start with chapter 12, right? So in chapter 12, now we're going to talk about entities, right? Go over the types of entities out there and the types of entities that are recognized for tax purposes. We're going to go over the characteristics, the tax characteristics and non-tax characteristics of these entities, right? And the goal is for you guys to know the the basic overview of different types of entities. So maybe later on, when you go to work or somewhere, and what if some client asks you what kind of entity should they establish, so then you have some knowledge about which type of entity going to fit best to your client business, right? So again, it's just an overview. It's not going to go. I'm not going to go much very deep into the characteristic of each individual entities. Um, so the goal is to introduce an overview, a broad view of what are available out there, and what is the main differences between one entity compared to others, right? So, all right. So I know in the book, they discuss a lot of stuff, and it's chapter 12 is pretty heavily on the concept. So in these lectures, we will just I'll try to touch on the most important things, you know. But I encourage you guys to, if you want to know more, to have a deeper details about the concept, then go. I encourage you to go read the book several times. All right. But for the lectures, I'll try to touch on the important things, the main differences of the entities. All right. Okay. So first of all, let's talk about what are the legal entities out there, available out there that you can set up. So there's several types, right? So first of all, let's talk about let's see, right? So we have currently for legal classification. So if you want to establish a business and you are figuring out what types of entities should you establish, right? Then you can either choose to establish a corporation, and in corporation there's C corporation and the S corporation, right? We can talk about that in previous chapters, right? And we have, besides that, we have limited liability companies, we have general partnership, we have limited partnership, and we have sole proprietorship, right? So how are these entities, how the types of entities different from each other, right? So we know corporation, especially C corporation, right? It is usually the most um, the most complex structures of business out there, and we know for C corporation, the owners or well, the company had to file its own tax return, right? And then all the other types of entities, the taxpayers, the owners, gonna be um, incorporate the income from the entities into their own tax return, right? So C corporation is the only corporation that the taxpayers have to file the tax return for the business itself, for the company itself, right? And all the other companies, we don't have to file tax return, file a separate tax return for the business, right? All right. So how do taxpayers form? How do people form the business, right? So for corporations, the owners, the one who want to build the business, have to file articles of incorporation, right, to the state, right? And then for limited liability companies, LLC, the owners also have to file articles of organization to the state, right? And for general partnership and limited partnership, usually the partners, right, the business owners who go into the business together, they have to write an agreement on the how the operation, how they can operate the business, and how the revenue, the income can be shared. Basically, all sort of thing that they want to agree on, they have to put into the agreement, the partnership agreement, right? And then for sole proprietorship, these are usually one owner's business, right? So usually for sole proprietorship, you don't really have to incorporate, you don't really have to file legal paperwork with the state, right? So you just start the business and you do it on your own, pretty much, right? Um, so let's talk about the difference in terms of characteristic of these entities, right? So let's talk about the non-tax characteristics, right? So what is the differences among these types of entities, right? So first, let's talk about the assumption of liabilities, right? So whether or not the owners of the business can be protected from the liabilities, right? So first of all, for corporations and for LLCs, right, the companies, the entities are the one who are responsible for the liabilities if there's such liabilities, right? So let's say if the business enter a loan, acquire a loan from the bank, let's see, right? So now they have a liability to pay back the bank, right? So the business itself is the one who is solely responsible to pay off the debt, the loan, right? And the bank cannot go after the owners to 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 uh, to ask for the payment, right? So, but for other type of entities such as sole proprietorship, the owners of the business have to be responsible for whatever liabilities that the business have, right? So in the case of the business with the loan from the bank, if the business fail to pay off the loan to the bank, then the business owners of this sole proprietorship business have to have I have to pay back the debt to the bank. Right? So and then for partnership, right? So we know there's a general partnership and there's limited partnership. Right? General partnerships means all partnership pretty much are treated equally in terms of a legal standpoint. So in the general partnership, all partnership going to be responsible. All general partners going to be responsible for the liabilities of the business. So if the business fail to pay, then the general partners have to step up and assume the liabilities of the business, right? In a limited partnership, so in a limited partnership is a little bit different, right? So in limited partnership, there are going to be two types of partners, right? So there are going to be one or so. There are going to be several partners who are general partners, and there are going to be several partners who are limited partners, right? And the limited partners, in other terms, you can call them silent partners, meaning for these partners, they don't have to assume the the liabilities of the business, right? But they don't have much right in they don't have much say in terms of running the business, right? So usually general partners are the one who have more say. They have more power in terms of how to run in terms of running the business, but they are the one who have to assume the liabilities, have to be responsible for the liabilities of the business. So the limited partners, they don't have to be responsible for the liabilities of the business, but they don't really have a say. They are silent. They just receive they're passive investor basically. Right? So for limited partnership, the general partners are still the one who assume the liabilities, right? All right, and we talk about sole partnership already, right? So that's about the responsibility of the liabilities, right? What about in terms of how in terms of the legal arrangement within a firm, how are the business owners, how can the business owners have a say, how can the business owners run the business, right? So different types of for it is different for each for each of the type of entities, so for example, for corporation, for C corporation actually, especially, right? um the business owners do not have the flexibility in terms of arranging the legal issues among each others, right? Usually, let's say if they want to have a say in how to run the business, or they want to change some policy, or change some something about the way that the business is run, they cannot do that for corporation, right? Whatever legal right, whatever um, whatever whatever right that they have is defined by the share that they own, the right. And usually share owners, they shareholders, they don't really have a say in how the business is run, you know. So that's for corporation, right? Usually the corporation is run by a team of management, right? And the management team, they can also investor of the firm, or they are not, right? They can be hired externally, right? So for corporation, the flexibility of arranging the legal issue among the owners are quite stiff, right? Is not flexible at all, right? And however, it is not that is not the case that the business owners don't have a say in how they run, right? So every year the C corporation have to organize a annual meeting, right? So for you can see for any of the big firm out there, like Walmart, Amazon, Apple, every year they hold an annual meeting, right, where investor can come and vote on certain issues, right? And if they want to vote, if investor want to vote on something, they can propose, right? They can prepare a proposal and then ask other investors to vote on it, right? So that's the only way that they can kind of express their opinion or express their um, their will in terms of if they want to change something, then they can do that at the annual meeting, but other than that, usually on a day-to-day course of a business, the business owners, the shareholders cannot just call up the CEO, call up the managers and tell, I want you to change this way. It is not how it works. That's C corporation, right? And so for C corporation, it is that way, right? And usually C corporation, the management, how the management have to abide to some sort of bylaw, some sort of corporate governance that has been set out by either by the government, by the agents, by the federal agents, right? Or they have to abide to certain requirement that has been voted on by the investors, right? So that's for the C corporation. In terms, and then LLC is also a little bit similar to C corporations. From the liabilities, so the investors, the shareholders don't have to to assume the liabilities of the companies, right? However, um, the good thing about LLC is that they allow the investors a flexible way to have a flexible way in terms of arranging the legal matters among each others, among themselves. So let's say if and it's not just for LLC, for partnership as well. So for LLC and partnerships, the shareholders, the business owners can have more say, as I say, okay, more say in how the business is operated, is run, right? So let's say if um, if some business owners, some shareholders are not happy about a certain way or a certain item in the business, then they can just go talk to the other business owners, and then they can, after they resolve the issue, then they can just put whatever they agree on in an agreement, right? And that can be easily do, right? So for LLC and partnership, it is very easy, right? It is very easy and it is common for business owners to make arrangement, to make adjustment to the operation of the business, um, you know, and for LLC and for partnership, the business owners, the shareholders, they have the flexibility to do such thing, right? Not like in corporation, right? Um, and then for sole proprietorship, since there's only one person who owns the business, so it doesn't really matter. All right, so let's see. This table is kind of summarize the main differences in terms of the non-tax characteristic of each of the entities. So you can see, first of all, how to organize the entities, right? So for corporation and for LLC, we have to file a form with the state, right? For limited partnership as well. So for limited partnership, for general partnership, you don't really have to file to file a legal form with the state, right? But for limited partnership, since now it's have to classify between the two classes of partners, then they have to issue, they have to submit the form to, they have to legally um, submit the paperwork to the state, right? And then so for general partnership and for sole proprietorship, there's nothing that the there's nothing legally that the business owner have to file with the state, right? So for the case of sole proprietorship, there's one exception. So one exception is that the business owner of the sole proprietorship can form the business as one owner's LLC, right? Meaning it is an LLC with only one owners. So if that's the case, then the business owners have to file to legally file the formation paperwork with the state, right? Because it is eventually it is ultimately it is an LLC, right? So that's why they have to file with the state, but only in that case, right? Only if the business owner want to file a one owner's LLC. Right? Other than that, they don't have to to file anything with the state. Right. All right. So talk about the responsibilities for the liabilities of the business. So we know that for corporation and for LLC, the business owners are protected, right? So all the liabilities are assumed solely by the business, and if the business fail to fulfill the liabilities, then the business owners are not going to be chased after, right? But for partnership and for sole proprietorship, usually the owners that's going to be the one who have to be responsible for ultimately responsible for the liabilities of the business, right? And then in terms of legal arrangement among the investor, among the owners, so for corporation is the only one that doesn't have that are very restrict in terms of arrangement. So everything come with the share, right? Everything is defined in the share that the business owners um, hold, right? So and business owners shareholder cannot don't have the luxury of getting involved with the business with the day-to-day operation of the firms, right? And if they want to change something or if they want to make some arrangement with another shareholders, it is more difficult for them to do that way. But for LLC, for partnership, usually it's much more flexible, and business owner can just make an acknowledged agreement on whatever matters that they want to deal with each other, right? And another point I want to mention is the relevant of initial public offering, right? IPO, right? So if what if the business owners now become very successful and he or she want to bring the business to the public, right? Make it public, make it a publicly traded entities, right? So which type of entities is the most suitable for doing such thing, right? So corporation is going to be the one who going to be the types who is the most suitable for initial public offerings, right? Because when after the IPO, right, there's going to be a lot of shareholders. There's going to be like thousands or with millions of shareholders uh, of the firms, right? So now we're going to have pretty much like millions of business owners of this business, right? So you can see like if there's such big amount of people, big amount of shareholders, and if they want to resolve something, then it is going to be like a mess, right? If any one of them want to call the management team to if they want to change something, it's going to be very very difficult, right? And it is basically not practical to do such thing, right? So that's why corporation is going to be the form that is the most suitable, because they corporation kind of the form of entity itself kind of block the business owner from getting involved too much, into the operation of the business, right? And yeah, that's why it is the most suitable form of entities that are suitable for going into an IPO, and then all the other entities are not really ideal for an IPO, right? That's why a lot of business started off as either a partnership or a sole proprietorship, and then after the business booming, they become very successful. Um, they will, and then right before they want to go into an IPO, they're going to change the form of the business into a corporation, and then they're going to file for an IPO, you know. And then sometimes there's some exceptional cases with limited partnership. So it's very rare, but sometimes limited partnership, in some certain industries, some certain cases, that limited partnership can also go into IPO. But but it's not that common, you know. All right, so so those what we just discussed about is the non-tax characteristics of the entities, right? So let's talk about the tax characteristic of the entities, right? So as we just talked about, right, there are how many types of entities? There are corporation, there's LLC, there's general partnership, there's limited partnership, there's sole proprietorship, right? However, for tax purpose, we only have either C corporation, S corporation, partnership, and sole proprietorship, right? So there's only 4 categories of business that are acknowledged for tax purposes, right? Um, so in some case, even though in a legal form, maybe the company is LLC, but if for tax purpose, maybe it's going to be treated as a partnership, right? And if the business, the LLC, the company is only have one owner, then it's going to be treated as a sole proprietorship, right? Pretty much. So the LLC can be treated as a S corporation or partnership, if they are eligible to be treated as a S corporation, then they can, So so for usually, how do we judge like which entity is? How do we judge the tax classification of the entities, right? So there's a rule, it's called check the box regulation. Basically, what it is, it says that any corporation can be treated as C corporation unless the shareholder elect the business to be treated as an S corporation, right? And it's not easy to be treated as an corporation. There has to be the corporation had to meet some requirements to be treated as an S corporation, right? But overall, the rule is if the corporation, if the business are registered as a corporation with the state, right, then it usually by default is going to be treated as a C corporation, all right. And then as we mentioned earlier in the lectures, right, C corporation is the only types of entities that are that have their own tax returns, right? So business owner have to file the tax return for the business itself, not to commingle the business with their own individual tax return, right? All the other entities, S corporation, partnership, sole proprietorship, the business income basically going to flow through the tax return of the business owners, right? And the business owner going to pay individual tax on that, on the income they get from the business, right? So again, C corporation is the only type of entities that have their own tax return, right? So all other unincorporated entities, going to be treated as flow-through entities, right? If they have more than one owners, like I said, they're going to be treated as a partnership, right? If they have one individual, they can be treated as a sole proprietorship. All right. However, the business owners of unincorporated entities, they still have a choice to whether to elect their business to be treated as a C corporation or an S corporation. It is still optional for them to do such thing, but by default, they're going to be treated as a flow-through entities. But if they don't want to that, they can make an election, and then they can treat their business as a S corporation or C corporation. All right. So this chart is kind of summarize the process of how we can judge the tax form of the business, right? So first of all, we start with the question: is the entity a legal corporation? So basically whether or not your business is legally filed as a corporation with the state, right? If it is yes, then it asks whether or not the business can be qualified as an S corporation, and you choose to do so, right? If yes, then you can treat the corporation as an S corporation, right? And then basically, S corporation is still a flow-through entities, right? So the business owner don't have to file a separate tax return for the business, right? If um, if the if the business is treated as a C corporation, then now the C corporation have to have their own tax return, and the taxpayers, the owners have to pay the corporate tax rate on the C corporation rate. And sometimes I say the C corporation is the only one that has their own tax return rate. By that I mean the tax return is going to be their own tax return, going to tell you how much they have to they need to pay tax on, right? They have their own tax rate, right, which is 21% as of right now, right? For S corporation, even though they're still a corporation, and they still, I mean, there's still some form that they have to file for themselves, right? But whatever business income from the S corporation is going to be flow through the individual tax return of the business owners, right? And they're going to be taxed on that, right? What about if the entity is not a corporation? Right? So if the entity is not a corporation, then the taxpayer can still choose to treat the business as a C corporation, right? But if not, then the taxpayers have to judge whether or not they are a partnership or whether or not they are a sole proprietorship, right? So if there's one owners, then the taxpayer can be treated as a sole proprietorship, right? But if there are multiple owners, then the taxpayer can treat their business as a partnership, right? All right. So this graph is just to kind of summarize the process, but I think it can be helpful. Right. So let's go through some scenarios, to see how we can judge, how we can classify a business for tax purpose, right? So in the first case, it says, assume Nicole legally forms a CCS, which is a company, as a corporation, right? By filing article of incorporation with the state. What are her options for classifying CCS for tax purpose if she's only shareholder of CCS? Right. So she's only a shareholder of the company, and the company is a corporation legally. Right. So the answer is she can treat the company as either a C corporation or an S corporation. The default tax classification is a C corporation tax purpose. However, even the five providers CI can be eligible to make an election to be taxed as an S corporation, right? And usually in usually if a corporation if a if a corporation only has one owners, then the corporation can be treated as a S corporation, and the business income can be flowed through the not only business owners tax return, right? So usually that's the case, right? But if C corporation have several owners, several shareholders, then they have to treat themselves as a C corporation. Right? So that's usually the case. So okay, so let's look at the second case here. Right. So assume Nicole legally forms CCS and an LLC, right, with only one class of ownership rights by filing articles of organization with the state. How can we classify this, right? So the answer is that the default classification of CCS is going to be a sole proprietorship, right? Because there's only one owners here, right? And LLC is not a corporation, right? However, Nicole can elect for the company to be treated as a C corporation or an S corporation, so that's what we talked about here, right? So even though it is not a corporation legally, but the taxpayers, the business owners can elect for the business to be treated as a C corporation, right, or an S corporation if they are eligible to, right? All right. What about this case? A student legally forms CCS as an LLC and allows other individuals or business entities to become members in return for contributing their cash, properties, or services to the company, right? So what is the classification? So in this case, it is a partnership, right? Because now the business have multiple owners, right? Multiple partners. So even though it is an LLC, but since there's multiple partners, multiple owners, um, the business is going to be treated as a partnership, right? All right. So I hope that is clear for you guys. And again, all I want to do is to introduce to you an overview of the of all of these entities, all of the form of entities and how are they different from each other. All right. So let's talk about the tax characteristic of the differences in tax characteristic of these types of entities. All right. So first of all, let's talk about C corporation, right? So as we know, the C corporation they have their own tax rate, right? They file their own tax return. They have their own tax rate that they have to pay, And now today, currently, the tax rate for corporation is the flat rate of 21%, right? Um, and then the shareholders, after they receive the dividend or when they sell the stock, they may have to pay tax on it, right? As we know, right? Um, so this right here create what they call double taxation, right? When the business owners, they have to pay tax at the corporation level at 21%, right? And then once the income on the after tax income distributed to them through either dividend or either when they sell the stock, right? They have to pay tax second times, right? So this what they call double taxation, and it's kind of like a drawback of forming a corporation, because there's two level of tax that you have to pay, right? And for flow-through entities, on the other hand, it is there's only one level of tax, right? Because the business income from the entities are not taxed at the entity level. Right? Whatever income they make gonna flow through the individual owners, right? Tax returns, and they're gonna pay tax at the individual uh, taxpayer level, right? So yeah, so that is so C corporation they have double taxation, and that's kind of like a drawback for this form of business, right? Um, so let's talk more about the flow-through entities. So as we know, the flow-through entities, they only have to pay tax at the individual level, right? And depending on the tax bracket of the individual investors, of the business owners, then they have to pay the tax at that tax bracket, right? So maybe it's higher than 21%, maybe it's lower than 21%. Um, so if it's lower than 20%, then maybe it's going to provide a great provide advantage compared to a C corporation. But if the tax is higher than 20%, then maybe it may create it may not a good idea to form business as a flow-through entities. So again, there's a lot of things that we have to consider in terms of tax characteristic. And then so that's why a lot of people, when they have a business idea, even though their business idea is good, but when it comes to establish establish the business legally, they may have confusion to pick what types of business may fit them the most. So that's where CPA accounting comes in, like you guys in the future is going to come in and give them advice, right? So that's why what we are doing right now is important. So, all right. So for flow-through entities, right? We know business owner is going to pay tax as ordinary income, right? Depending on the individual tax rate, tax bracket, right? Then on top of that, if the business owner is a passive investor, For example, maybe the business owner is limited partners, right? They don't engage in running the business. Um, they're just a silent partners, and they're just there to receive the payment, the share payment, the share income when the business generate income, right? So for passive investor, they may have to pay a 3% of net investment income tax, right? And we kind of talked about this in previous chapters. So it's additional tax for them, right? And then if the owners of the business um, involved in the business, involved in running the business, then they may be subject to pay for the self-employment tax, right, or the additional Medicare tax, right? And this basically FICA taxes when they are self-employed, right? Which we talked about in chapter 8, right? Um, and then for S corporation shareholders, right? They they're not subject to pay for self-employment tax or additional Medicare tax, right? But so for S corporation, whatever business income is going to flow through the individual taxpayers, right? And the individual taxpayers going to pay can also have to pay tax at the individual level, on the ordinary income, and then they also have to pay um, what's just forgot. So um, for owners of flow-through entities, for because uh, they also have some different. They also have some certain deduction that they are eligible to deduct, right? So remember in a chapter, I forgot what chapter it is, when we talk about form AGI deduction, right? So besides form AGI deduction, besides itemized deduction or standard deduction, we also have qualified business income, right? So when the taxpayers is the business owners, and if their business qualify for this, they may deduct 20% of the qualified business income as form AGI deduction, So that is one benefit that taxpayers, that business owners of flow-through entities have, right, from setting up flow-through entities, right. And then what is qualified business income? I'm not going to talk about that because we already covered. But if you want to, you can go back to, I think, chapter 7, where we talk about this, And I think in this chapter they also repeat again, like what is qualified business income, but and what can be considered as a qualified business, But it's very lengthy. I'm not gonna mention it here again. So yeah, but remember that, right? For qualified business income, the business owners can deduct 20% of that, right, as their form AGI deduction. And remember that the 20% of qualified business income is not included in itemized item, right? So it is on top of itemized item, right? So whether or not you select to use itemized item or itemized deduction or standard deduction, it's not going to affect this, right? So this is on top of standard deduction or itemized deduction, right? So it is good, right? It's good for business owners to have such deduction. All right, and then besides the deductions, the business owners still have to pay some additional taxes, on top of the ordinary tax that they have to pay, right? So we know that, right? So first of all, for high income taxpayers, right, and if they are passive investors, they may have to pay 3% on investment income, right? And I think we will talk about this in chapter 8, I think, right? And then besides that, the business owner also have to pay the self-employment tax, right? Which is the FICA taxes, right? So which is in FICA tax we have Social Security tax and we have Medicare tax, right? And the for self-employed taxpayers, they have to pay the portion of individual income tax. They have to pay the employer portion of FICA by themselves, right? And they also have to pay the FICA portion of the employee portion of FICA tax, right? So remember, FICA tax, that's the employee portion and that's the employer portion, right? And each of the portion is going to be the same, right? It's going to be I think it's a 6.2% of Social Security tax plus 1.45% of Medicare tax, right? So that add up to each other is going to be 7.65, I think 7.65 of 7.65%, right, of FICA tax for each portion, right? So 7.65% of FICA tax for employee and 7.65% of FICA tax for employer, right? So for self-employed taxpayers, they have to cover both, right? So that bring it up to 50.3%, right? And the it should be 132,900. And if you remember, for social security tax, there's a cap on the tax base, right? So if the income, if the tax base um, exceed 132,900, then the taxpayer don't have to pay tax on social security tax anymore, right? So after the income, if the income exceeds 132,900, then the taxpayers only need to pay the the excessive portion, only have to pay the Medicare tax on the excessive portion, right? That's why if the income go above 132,900, then the tax is only 2.9%, and this 2.9% it is the Medicare tax, right? Um, so I'm not going to go over that much more. If you want if you forget about this, you can go back to chapter 8 and see how we treat FICA tax, how we calculate FICA tax for self-employed people. And then remember, on top of that, there's additional Medicare tax based on the level of uh, based on the level of I think modified AGI. So if the level is above 250,000 or 125,000, or if the level of AGI go above this threshold, then the taxpayer have to pay additional 0.9% of Medicare tax as well, right? So all of these are covered in chapter 8 already, and I'm not gonna talk much about that anymore. But if you want to refresh yourself, then go back to chapter 8, right? All right, so let's look at this example, and the example is kind of similar to one of the homework. So I hope that will help, right? So let's see. So say assume that Nicole from this company forms the company as an LLC with another investors, so that now the company can be taxed as a partnership, right? And Nicole makes the following assumption. So the company CCS earns business income of $1 million, and Nicole's share of business income is $500,000, right? Nicole's marginal ordinary tax rate is 37%. Nicole is entitled to full deduction for qualified business income, right, on the flow-through income from CCS, right? So she has qualified business income, right? And then Nicole work full-time for the entity, so the business income allocated to herself is self-employed income, right? And Nicole marginal self-employment tax rate is 2.9%, right? Because now her income go above the 132,900 now, right? She had a source of income that put her earnings from self-employment over 132,900, cut off a 15.3% rate. And then the entire net earnings from self-employment from income allocation is subject to a 0.9% additional Medicare tax, right? So how do we solve this? So the question asks, what is the overall tax rate on the company business income allocated to Nicole? Right. So first we start with the business income allocated to this lady, right? So she got $500,000, right? She got $500,000 of business income allocated to herself, right, from the business, right? And then remember, for self-employment, um, tax, right? We have a deduction for AGI, um, which I think we discussed in chapter 6, I think, right? So in this case, she can deduct the 4 AGI portion, right, from the business income rate. So we take $500,000 times 0.9235, right, times 0.029, right? 0.029 is going to be the self-employment tax right now. Now it is her marginal rate for self-employment tax, right? And time 0.5, right? And remember why it is 0.9235. So if you don't remember, go back to chapter 8 and see, this is the way we calculate the base for self-employment tax, right? We take the self-employment income, gross income, right, times 0.9235, right, to get the base of the net business income, right? And then we times the marginal rate for self-employment tax. Right? That's how we calculate the self-employment tax, right? So this right here, right, this one time, like $500,000 time 0.9235 time 0.029. This is the self-employment tax, right? And since 50% of self-employment tax can be deductible as a 4 AGI deduction, so that's why we time 0.5 here, right? So and then we also have deduction for qualified business income, right? Because in this case, they say that Nicole is entitled for full deduction of qualified business income, right? So we take $500,000, we subtract this, right? Subtract 4 AGI, right? Now we have the income item that is before form AGI, right? And then we subtract and then we times 20%. So that's going to give us the deduction for qualified business income, Oops. All right. So and then the net income, right, before applied anything, right, it's going to be the $500,000 subtract these two item reduction, right, 4 AGI deduction and form AGI deduction, right, and then we get to the income after deduction, right, and then now we need to start. Now we're going to use this to calculate the ordinary income tax liabilities for Nicole, right? So we take this amount, right? This net after deduction, right? This pretty much what we call taxable income, right? So 644 times 37%, right? Because that is her marginal tax rate right now, right? And that's going to be 146,018, right? So this is going to be owner level income tax, which is ordinary income, right? And then we also have to calculate the self-employment tax rate, which is what we already know, right? So $500,000 times 0.9235 times 0.092 are going to give us 13,391, right? And this is pretty much FICA tax rate, remember? And then since Nicole is also have to pay for additional Medicare tax, so we take this amount, right, $500,000 times 0.9235 times 0.009, right? That gives us 4156, right? And then from there we can calculate the total tax paid on the the business portion that she received from the business income that she received from the business, right? So we add these three amount up together, right? And that gives us 163,565, and the overall taxation is going to be this number divided by the $500,000, right? That gives us 32.71%, right? So there's a lot of things going on here, right? So we have pretty much we have the tax formula, right? And then we also have to calculate the FICA taxes and addition of Medicare taxes here, right? So yeah, so I just want to show you like how a problem like this can be done. You know, I don't plan to ask you like such complicated problems on the test on the exam 4, but yeah, it is. I still want you to kind of know how to solve such complex problems. You know, because you may need to know this to solve your homework and for futures for your future job. Right? So. All right, so I hope that is clear. Even though it's complex, you know, but once we kind of understand how to solve it, right, it's basically what we already covered, right? So from the first 4 to 5 lines here, pretty much the tax schedule, the tax formula that we covered back in like chapter 4 or chapter 8, right? And then all of this self-employment tax, additional regular tax, we know how to do it from chapter 8, right? So it should not now like this problem is like a application of whatever we have learned so far, right? So it should not be that hard. All right. So what else, right? So what we just talked about is the tax characteristic of flow-through entities, right? So what about C corporation, right? So we know C corporation they only pay they excuse me, they pay their own tax rate, right, which is a 21% flat rate, right? And then we have double taxation, right? Because after the after-tax income, uh, after taxing out the corporation, they're going to distribute that to the investors, right, as either dividends, right? So dividend, the investor have to pay tax on the dividend received as well, right? So that's the second level of taxation, right? So we have the corporate level and then we have the individual level, right? And we know the individual shareholder have to pay for qualified dividend. They're gonna pay the preferential tax rate on it, right? And if the if they decide to sell the stocks of the company, right? And if the stocks if they hold the stock for more than 1 year, then the gain on the stock can be they have to pay the preferential tax rate on the gain, right? But if they hold the stock for less than 1 year, then they have to treat the gain as ordinary income, right? Now on top of that, they may have to pay the 3.8% of net investment income, depending on their tax bracket, their not tax bracket, their income level, right? So yeah, so for C corporation, for tax wise, right? They remember that they have to have a double taxation. They have 2 levels of taxation. Right? So let's look at this example. So say Nicole chooses to form her business as a C corporation, and she makes the following assumption: CCS earned taxable income of $500,000. CCS will distribute all of its after-tax earnings annually as dividends, right? And her marginal ordinary tax rate is 37%. Her dividend tax rate is 23.8%, and this including the net investment income tax, right? Because her income is pretty high, so she had to pay 20% of 20% on qualified dividend plus 3.8% of net investment income, right? So the question asks, if Nicole organized CCS as a C corporation, what would be the overall tax rate on CCS income? Right. So let's see. So we know that the taxable income is $500,000, right? And then it is a C corporation, so it has to pay 21% of corporate tax rate, right? So the corporate level tax gonna be $105,000, right? And then um, assume that this income, well, you already say that whatever after tax income is going to be distributed to the owners, right, which is Nicole, 100% as dividend, right? So now after tax income is $395,000 distributed to Nicole as dividend, and now Nicole had to pay the 23.8% tax rate on the dividend, right? So now the tax liabilities on the dividends is going to be 395 times 23.8%, which is going to get us $94,010, right? So the total tax paid on the corporate taxable income is going to be this amount, right? $105,000 plus $94,010, and that's going to give us $199,010, right? And the overall tax rate for corporate income is going to be this amount divided by $500,000, and that equals 39.8%. So pretty high, right? Yeah. So this example is kind of show you um, how to calculate the true level of taxation, right? The double taxation, right? And for high income taxpayers, as you can see, the tax can be the overall tax rate, the average tax rate can be really high for the income that they receive from the company, right? So in this case, maybe forming a C corporation for Nicole is not, maybe it's not a good idea, right? All right. The corporate tax level on their income rate, and after that they distribute income to corporation A, right? And then corporation A, now after they receive the dividend, they have to pay tax on the dividend, right? Which most likely is going to be the 21% flat rate on the income tax, on the corporate income tax, right? And then, so that's the second level, right? And then the corporation A is going to start to distribute the income to their own shareholders, right? So then their shareholder have to pay tax on the distribution that they receive from corporation A, right? So this is the third level, right? So because there's this triple level of tax paying, right? That's why there's a program called dividend receive deduction that is created to reduce the burden of the the shareholder of company A, right? Of the company of the corporation who owns who holds share of another corporation, right? So what is this dividend receive deduction program? Basically, it allowed um, allowed the corporation, corporation A to to deduct like 50% of to deduct a certain percentage of the dividend they receive, meaning they don't have to pay tax on that portion that they exclude, right? So for so and how what is the level of percentage, the level of excluded percentage is going to be depends on the level of ownership that company A has in company B, right? So if company A owns less than 20% share of company B, then company A can exclude 50% um, of the dividend that they receive from company B, right? If company A owns anywhere between 20% and 80% of company B, then they can exclude 65% of the dividends they receive from company B, right? If they receive, if the company A own more than 80% of company B, then company A can exclude 100% of um, of dividend that they receive from company B, right? Meaning they don't have to pay tax on that, right? What about when the investor is an institutional shareholders, right? And what is institutional shareholders? Institutional shareholders basically they are, let's say, an example can be a mutual fund, right? Or an um, insurance company that way that they professionally invest in that they maintain a portfolio of investments, right? So for institutional shareholders, they don't have to pay the shareholder level tax dividend, right? So that's a good thing for institutional shareholders, right? And usually for church or for university, usually they have their own endowment, right? And they invest in different corporation, right? Usually they are exempt. They are not responsible. They are not liable to pay um, tax on the investment, on the dividend income that they receive from the investment, right? So yeah, and some companies they don't want to they kind of try to not create the double taxation situation. So a lot of firms they don't pay out dividends, right? They hold the earnings, right? They hold the earned income and not distribute out to the investors, right? And like I think the example can be Apple. Like Apple, I think a few years ago they didn't start to pay dividend until like a few years ago. I remember. I'm not sure if they still paying, but yeah. So for firms, usually they just hold off paying the dividend, right? So then you may ask, how can investors receive like their earnings, right? Well, they can still receive their earnings by sell off the share, right? So if firm don't pay out dividend, right, then they will have more resources, more fund to reinvest in some other project, and the growth in the future is going to be higher, right? So that alone, that opportunity alone can increase the stock price a little bit, right? And that can defer the tax that the investor had to pay, right? Because if the corporation pay out the dividend right away, then the taxpayers have to pay immediately have to pay tax on the dividends they received, right? But if the corporation don't pay out dividends, then the stock price gonna increase, uh, keep increasing, right? And the taxpayer don't have to pay tax right away, right? And if the taxpayer don't have to pay, the shareholder don't have to pay tax right away until when they sell the share, right, and capitalize whatever they receive, right? So when they share when they sell the share in the futures, if they hold the share for more than 1 year, then whatever gain income is still going to be treated as long-term capital gain, right? And still they still pay the preferential rate, right? However, they don't have to pay the rate back then they can wait until when they sell the share, right? So that way the taxpayers, that way shareholders can defer the the tax that they have to pay on the earnings, right? So yeah, so this what I just talk about is like the basic of corporate finance. It's like one of the main topic of in corporate finance. So if you guys took a class in corporate finance, you can see clearly what I should talk about. But uh, anyway, I just want to introduce you like this concept. So there's a way for corporation to avoid or at least to defer, to postpone the second level of example. It says assume that Nicole invites the corporation to invest in CCS in exchange for a 10% share in the company. And then Nicole makes the following assumption as part of her calculations. So CCS is C corporation. CCS earned taxable income of $500,000. CCS will pay out all of the after-tax earnings annually as dividends, right? And it asks, given this assumption, what would be the overall tax rate on the corporate investor's share of CCS income, given that the shareholders corporation would be eligible for 50% dividend received deduction, right? Well, because so this is the example of a case where that's the corporate shareholders, right? And in this case, the corporate shareholder own 10% of the companies, right? 10% of CCS. That's why it is eligible for 50% of 50% of dividend receipt deduction, right? So let's start with first. Let's start by calculating the after-tax income of CCS, right? So we know CCS is a corporation, so it's going to pay 21% of flat tax rate on its income rate. So we have the taxable income is $500,000 times 21%, and that's going to give us $395,000, right? After tax income, right? And then this corporation is owned 10% of CCS, right? So that's why the dividend is going to be 10% of $395,000, right? Which equals to $39,500, right? And because this company is eligible for 50% of dividend receive deduction, right? So we can exclude 50% of the dividend that this company received from CCS, right? So we take 39,500 times 50%, right? Pretty much one subtract 50%, and that gives us 19,750, right? So this is going to be the dividends they received from this is taxable dividend that this corporation, right, this company that they receive from CCS, right? So on this 19,750, they have to pay tax on it, right? And they're going to pay 21% of corporate tax rate on that, right? So that's going to be 4148 right here, right? And then since there's still a double taxation, right? Because they still this corporation, they still have their share of the corporate tax that CCS has paid, right? So which is 10% of 10% of the 105,000 right here, right? So that why we have the corporate investor share of the entity level tax at $10,500. So we add these two back, add these two up, and that's going to give us 14,648. And this is the total amount of share that these corporate investors had to pay, had to assume on the income that they receive from CCS, right? So that so now to calculate the tax rates, we take the 40,648 divided by $500,000, no, divided by 10% of the $500,000, right? And that gives us 29.3%, right? So yeah, so this is an example, like I said, this is an example of when there's a corporate shareholders, right? And as you can see, because of the deduction, dividend receipt deduction program, this firm has saved a significant amount of tax, right? And that is the purpose of this program, right? Because this um, it reduced the triple taxation, right? And the triple taxation meaning now after this corporation have paid two level of tax, uh, now if they want to distribute this dividend to their own taxpayers, and then their own shareholders, then their shareholders have to pay tax again. Right? That's the third level. So that's the purpose of this. So the purpose of this dividend receipt deduction program is help reduce such reduce the extent of the triple taxation, right? All right. Um, let's talk about owners compensation. I think we kind of run out of time, but let's try to push on. I think we don't have much left, and this chapter is not that long. So let's talk about owner compensation, right? So what's the difference? How how do these entities treat owner compensation differently, right? So for sole proprietorship, um, the entity don't have to pay anything, right? All of the income from sole proprietorship going to be transferred to the individual owners, right? And the individual to pay tax on it. So the entity itself don't pay anything to the owners. The entity itself don't recognize the compensation to the owners, right? For S corporation and C corporation, so for these two types of corporation, right, they have to pay the FICA tax for the employees and also for the employers portion, right? As entities, right? So I'm talking about the entities, right? So the entities have because they are a corporation now, right? They themselves are the employers, um, right? So the company itself have to pay the FICA tax portion of the employee and the FICA tax portion of the employers, right? And if the business owners also work for the corporation, then they can also deduct the compensation of that they paid to the owners as well, you know. But overall, any compensation for employee and any compensation for the owners, if the owners are fully participate in managing the business, then the compensation can be deductible for the corporation, right, in their own tax returns, right? All right. What about partnership? How partnership recognize um, the compensation to employee and to business owners, So usually um, business owners they usually the partnership they don't as an entity, as an entity partnership don't pay the FICA taxes for their own business owners. Basically, whatever income that they receive, they distribute right away to uh, to the business owner. That's what we call guarantee payment, right? So whatever income, it's going to be whatever income that they make, depending on the agreement on distribution of among the partners. Then the partners going to receive the payment right away, right? And then the partners themselves pay their own FICA taxes pretty much and self-employment tax, right? Excuse me. Um, yeah. So the main difference between among this entities, right, is that S corporation and C corporation, as an entities, they pay FICA tax to the employer and the employee portion, right? If they hire the owners, then they're gonna pay the FICA taxes for the owners as well, right? As an entities, right? But for sole proprietorship and for partnership, since the income is flow is distributed right away to the owners, so the owners themselves if they work for the if they work participate in managing the business, right, then they themselves have to pay their own FICA taxes, pretty much their own self-employment taxes, right? So let's look at this example, right? So this example I pull out from your homework, right? And this kind of showed how we can recognize FICA taxes, how entities treat FICA taxes differently, right? So it asks Dave. It says Dave and his friends still work. Each owns 50% of KBS. During the year, Dave received $83,000 compensation for service he performed for KBS during the year. He performed a significant amount of work for the entity, and he was heavily involved in management decision for the entity. Right? So basically, he's not a passive investor, right? After deduct Dave compensation, KBS report taxable income of $33,200,000. So it asks how much FICA or self-employment tax is Dave required to pay on his compensation and his share of KBS income if KBS is formed as a C corporation and as an S corporation or as a limited liability company, right? So let's look at how we look at how they do it, right? So first of all, for FICA tax, right? So um, they they pay since they're a corporation, right? They pay they already pay they already take care of the uh, employer portion of the business, right? But for since in this case, Dave he still work for the company, right? So basically, he can be treated as part of the employee of the companies, right? So the company in this case is going to pay FICA tax for him for the employer for the employer portion, right? And then Dave himself have to be responsible for paying the employee portion, right? So that's why for C corporation or S corporation is the same, right? So that's why for the first two cases, right, for C corporation and S corporation, they've had to pay FICA tax of $6,350 calculated by taking $83,000, which is his compensation paid by the company, right, times 7.65%, right? And this is the employee portion, right? Right. So that's his all the amount that he had to pay on FICA taxes, right? But in the case of LLC, right, and this case can be treated as a partnership, right? The since the firm, right, the company don't pay the FICA taxes for him, right? Because all of the incomes flow through his individual income, right? So Dave himself now is responsible to pay for both the employer portion and the employee portion, right? Remember back in here, right? Right. That's why what they call self-employment income. Right? Self-employment income basically is the FICA taxes of the owner portion and the FICA taxes on the employee portion. Right. They are exactly the same. It's just double it. Right. So now the owner have to pay double the taxes. Right. Um, right. And I want to clarify this here. Right. So in here they say that they're subject to FICA. Right. Employee portions. Right. But what I meant here is the corporation itself is responsible for paying the employer portion, right? And then um, for for the uh, let me rephrase the owners of the business, right, the owners of the corporation is responsible for paying the employer portion of FICA taxes um, for the employees, right? Um, yeah, that's what I meant. Right. So let's get back to our example. Right. So we have yeah. So we already know we're talking about when the case of C corporation, S corporation, right? So because the company pay the portion, the employer portion already, right? So now the employee, now the owners, right? They've since he's employed by the company as well. So now he only have to pay for his employee portion, right? Which is 6350. We calculate for it. We already calculated here, right? But in the case when the firm is an LLC, right? In this case, the LLC, the firm, they don't pay the FICA tax portion for the FICA, the employer FICA tax portion anymore, right? So now the business owner have to pay both the FICA, the employer portion and the employee portion, right? So that's why in here FICA we haven't talked about it yet, right? But for self-employment, they call it self-employment, but essentially it is FICA, right? For self-employment income from the entity compensation, it's $83,000, right? And then the self-employment income from portion of entity business income is going to be um, after everything, so $33,200 is the net earnings of the corporation, right? Of this company after all expense, after paying Dave $83,000, everything. Right? The net earnings is the taxable earnings is 33,200, right? And since Dave own 50% of the firm, that's why um, he also received on top of the salary, right? He also got the payment of 16,600, right? All right. So in total, what Dave received, the self-employment income of Dave is going to be the sum of these two, right? It's going to be $99,600, right? And then from here, we're going to calculate the self-employment tax rate, which is the FICA taxes for self-employment, right? So first we calculate the base, right? The net earnings from self-employment going to be the taxable, the self-employment income times 0.9235, right? Which like this we already covered in chapter 8, right? That gives us 91,981. And then now we have to take this amount times 15.3%, right? And 50, the reason it is 15.3% because now the business owners, the self-employment business owners, had to pay both the employer portion and the employee portion, right? That's why it's 15.3%. Otherwise, if they only had to pay half, right? Like in this case, they've only had to pay the employee portion. Uh, that's why it's only 7.65%, right? But in here, since it is both employer portion and employee portion, that's why it's 50.3%, right? So that gives us $14,073 of FICA taxes. Right? So yeah, so we can see that the difference between the two scenarios, right? So yeah, I hope I explained this clear enough. You know, it can be quite complex, but if you have any question, just let me know. All right. All right. So let's talk about deductibility of entity loss. You know, so for C corporation, you know, so first of all, let's define what is net operation loss. You know, so net operation loss means after everything, right? After you deduct the all of the expense allowed um, from your income rate, and then whatever ending balance that you receive is a loss rate, a negative number, then we call it net operating loss rate. So usually, currently, you know, if you have a net operating loss, you can either you can carry forward indefinitely, right? Meaning if next year you have a gain. Each year you have next year you have a net income, or you have net earnings. Then you can use this year loss to offset the next year net earnings, right? And it can carry forward indefinitely, right? But there's no carry back, right? But before, in the old, before the tax rule change, before 2018, the business can carry the net operating loss forward 20 years and carry back 1 year, right? And before 2018, they can offset the loss, can offset up to 100% of taxable income in the year, but currently the limit is only 80%, right? So you can only use a loss to offset 80% of the income, the taxable income, um, in a year that you decide to carry it forward, to carry the net operating loss forward, right? And remember that the net operating loss can only offset the income of the business, right? It cannot be used to offset the owner's income, right? So that's for C corporation. For flow-through entities, right? Remember, for flow-through entities, in order to deduct the net operating loss, we have to go through the basis rule, the at-risk rule, the passive activity rule, right? We have to go through this 3 hurdle, plus the final hurdle is the excess business loss, right? We have to go through all of these hurdles to identify the amount of loss that can be used to deduct the business owner's income, right? Remember, we talked about this in, I don't quite remember what exactly is the chapters, but yeah, we talked about this for quite a while, right? So yeah, so business owners, if they want to use a loss to deduct their income, they have to go through all of this rule, right? So yeah, so yeah, let's go through some of the example. Oh, I forgot. Yeah, so this is going to be the last item that we're going to talk about, right? And then after this, we're going to practice a few example together. All right. So what about when the business owner want to convert their entities into other entity types? So for example, for C corporation, convert to other flow-through entities, and for flow-through entities to convert to C corporation, right? So how can they do that, right? So for C corporation, they can again, if the the first way that they can do, the first way that business owners of C corporation can do is to elect to treat the C corporation as an S corporation, right? But only if the C corporation is qualified to be treated as S corporation, right? If the C corporation does not meet the qualification, then that option is not viable anymore, right? So that's the first method. The second method that they can do is to liquidate the C corporation, right? And then form a new entities. And then the new entity that can change it to a partnership or change it to a S corp or LLC, whatever they want, right? But usually the second method is not that easy, right? It is involved a lot of paperwork, and it involves a lot of effort to calculate the tax cost of the liquidation of the C corporation, right? So usually converting from C corporation to a flow-through entities is much more challenging, right? But on the other hand, converting a flow-through entities to a C corporation is fairly easy, right? Usually there's no significant cost that the business owners have to pay to switch from a flow-through entities to a corporation, right? And usually, like I mentioned earlier in the lectures, right, right before the IPO, usually business is going to change their legal form to a C corporation, right, so that they can go through the IPO smoothly, And some firms they start doing that now because the corporate tax law have been reduced to 21%, right? Before it was like 35%, I think, but after the tax law change, it's reduced to 21%. So some business owners they do it because of the corporate tax reduced, right? Um, but anyway, the decision to change the legal types of the entities, it has to be considered in detail. Business owner have to give it a lot of thought and have to consider the tax benefit and the non-tax benefits of doing such things. But the option is out there. If they want to switch the entity types. All right. So yeah. So that's the end of chapter 11, and let's go through a few examples together. I hope they're gonna help you with the exam 4 and with the homework. Right. All right. So let's look at the first questions. So assume that Nicole will organize CCS as a C corporation, and that in spite of her best efforts as CEO of the company, CCS reports a tax loss of $50,000 in the first year of operation. Also, Nicole's marginal tax rate is 37%, and her husband's salary for year one is $500,000. Right. Nicole filed joint tax return with her husband, and it asks how much tax will CCS pay in year one, and how much tax will Nicole and her husband pay in year and pay on $500,000. So pay on the $500,000 of other taxable income if CCS is organized as a C corporation, right? So because CCS is a C corporation, then they have to pay the entity itself, right? The company itself had to pay the 21% flat tax, right? But because CCS is having a loss right now, right? It doesn't recognize a gain. It is reporting a loss for the first year, right? So in this year, the company going to pay 0% in tax, right? And yeah, and because CCS, the company is a C corporation, right? So um, Nicole cannot use the loss to offset her own personal income, right? Her own income. So that's why Nicole and her husband still have to pay 37% on the $500,000 that they make, right? Because they file jointly, right? So yeah. So that's the first example. Let's look at the second example. Right. So suppose CCS is organized as an S corp, and Nicole's basis in her CCS stock before the $50,000 year loss is $100,000. How much tax will CCS pay in year one, and how much tax will Nicole and her husband pay on the $500,000 of other income, assuming Nicole passes the basis at risk and passive activity rules, right? So now CCS is a S corporation, right? And as we know, S corporation don't pay corporate tax, right? So the answer is going to be zero, right? CCS itself going to pay $0 in tax, right? However, what about Nicole, right? So Nicole now she can, because CCS now is an S corp, right? So it is a flow through entities, right? So the loss of CCS now can be flow to offset the personal income of the individual income of the owners, right? So that's why $50,000 here can be used to offset the income, right? And since Nicole basis is $100,000 and then she passes all of the basis risk at risk and passive activity rules, right? Then she can deduct the whole amount of $50,000 lost here, right, to offset her husband income, right? Because they're filing jointly, right? So that's why uh, we can use the $50,000 to offset the $500,000 on taxable income. Right? So now the taxable income become for $50,000, and we use that to times 37% to get to the tax liability amount, right? So, all right, so that's example number two. It's really all of this we already covered in previous chapters, right? And in this chapter as well. So So if I ask something like this on the on exam 4, I expect you guys can do it. All right. So so in this exam, this table is just kind of summarize the finding of the first two example, right? So let's move on. So let's look at example number 3, right? So it says suppose that now CCS is organized an S corp, and Nicole's basis before the $50,000 loss is $100,000, and further assume that Nicole does not participate in CCS business activities, right? And assume that she is a passive investor in the business. How much tax will Nicole and her husband pay on the $500,000 of other income, right? So we know like now she's a passive investor, right? Meaning she doesn't pass the um, she doesn't pass the oh the she didn't pass the passive activity task, right? So that means she cannot deduct the loss. She's not allowed to deduct the loss to her personal income, right? So that's why um, her husband still had to pay. She had to use $500,000 as the tax base for their tax, right? So still they have to pay $185,000 because they cannot deduct the $50,000 um, loss, right? They're not allowed to because she's a passive investor, and passive investors, um, and she doesn't pass the passive activity rules, right? Um, right. So let's look at example number 4. So it says suppose that CCS is organized an S corp and is incur a $1 million loss for the year, and equal basis for the loss is $600,000. How much of the loss can equal deduct in year 1, right? And I guess we can assume that she passed all of the 3 tests, right? At risk basis and um, basis activity rules, right? Let me copy that. Okay. Right. So assume that she passed all the tests, and her basis was $600,000, and then the loss was even $1 million, right? So how much can she deduct, right? So remember that's the excessive loss deduction rule, right? So meaning the taxpayers cannot deduct above $410,000, right? That's the limit, right, for married filing jointly couples taxpayers, right? So the answer is $510,000 because she cannot, even though the loss was 600, the loss was $100,000 and her basis was $600,000, right? So and then she passed all the tests, so technically she can deduct the whole, she can deduct $600,000, right? But since there's the excess loss limitation, right? Then she can only deduct $510,000, right? Remember the excess loss limitation limit was $510,000 for married filing jointly taxpayers, and then I think it's $255,000 for others taxpayers, right? So yeah, so the answer is $510,000. So yeah, so that's it. That's the end of these lectures. I'm sorry the lectures go on for very long, um, longer than usual. It's like one like 20 minutes more than our usual class. But yeah, but that we good thing is that we cover the whole chapter 12. So I know this chapter is very conceptual. There's a lot of stuff in the readings, but um, don't worry. I'm gonna tell you. I'm gonna let you know the topics that I want to focus on for exam 4. I'm gonna create a review session and I'll let you know the topics that I want you to focus on. So yeah, so don't worry too much. All right, so yeah, so if you have any questions, just let me know. and I see you in the next video that will be on chapter 13. All right, take care.